In 1981, a congressional banking committee sealed a 400-page financial report, and the one section they quietly removed described a method ordinary Americans had used for decades to escape the banking system entirely. That section has never been released. By the end of this, you'll understand exactly what was in it, and why every major bank in this country needed it buried. Before credit cards, before the Federal Reserve controlled most American savings. There was a system, simple, legal, hidden in plain sight. Ordinary families, farmers, tradespeople, factory workers kept their money inside whole life insurance policies, not because they were afraid of dying, because those policies grew. They earned guaranteed interest every single year with no market risk attached. And here's the part almost nobody mentions: you could borrow against that money, instantly. No credit check, no bank approval, no interest paid to a stranger. You were the bank. This wasn't some fringe idea. By 1930, American families held more money inside life insurance companies than inside all commercial banks combined. Then 1933 happened. The Glass-Steagall Act restructured the entire American financial system. Banks got new powers, new protections, a federally guaranteed safety net. And slowly, not overnight, but with the patience of an institution that had time on its side, the banking industry began positioning itself as the only logical place your money belonged. Savings accounts, CDs, money market funds, all of them paid you interest, just enough to feel like you were winning, not enough to matter. What they never advertised was the spread, the gap between what they paid you and what they charged someone else for that same money. Banks lend your deposits out at 8, 10, 12%. They pay you back at 1, sometimes less. The difference, that's theirs, and the whole life system, the one that let you capture that spread for yourself, didn't disappear. They just made sure no one was taught it anymore. The official story is that whole life insurance fell out of favor because term insurance was smarter. Cheaper premiums, more coverage, better for modern families. That's true as far as it goes. But the financial press driving that narrative in the 1970s and 1980s, funded by firms that sold term policies and invested the premium difference into mutual funds they managed, for a fee. Nelson Nash noticed this. He was a forester from Alabama who had spent 20 years quietly using dividend-paying whole life policies as his personal banking system. He wrote down exactly how it worked. His manuscript was rejected by every mainstream financial publisher he approached, every single one. He self-published it in 2000. It sold quietly. Word of mouth only. No bookstore placement. No financial media coverage. Just people who found it and couldn't stop talking about it. Here's what makes the silence impossible to dismiss as coincidence. In 1979, the Federal Reserve changed how it calculated the money supply. M1, M2, the official categories that define what money even is in this country, and they quietly removed a line item that had appeared in those reports every single year since 1959, the cash value of life insurance policies held by American households. Just gone. No announcement, no explanation in the congressional record. One year it was there. The next year it wasn't. At the time of that removal, the figure stood at $1.6 trillion. Sit with that. $1.6 trillion held by ordinary Americans in a vehicle that paid guaranteed interest, allowed borrowing without a credit check, and kept money entirely outside the commercial banking system. And the Federal Reserve quietly stopped counting it. Because if the Fed counts it, Congress asks about it. If Congress asks, constituents ask. If constituents ask, they start using it. And if they start using it, they stop needing banks for the one function that earns banks most of their money, lending your own deposits back to you at interest. Nash calculated that if just 10% of American households redirected their savings into properly structured whole life policies, commercial bank deposits would fall by $800 billion. They ran the numbers. So did the banks. The families who quietly kept using this system didn't get rich overnight. But something unusual happened to them over time. They stopped carrying consumer debt. They financed their own cars, paid themselves back with interest, and those payments compounded inside a policy that never went down. Small businesses bought equipment without asking a lender for permission. Children went through school the same way. And when 2008 hit, when markets collapsed and retirement accounts lost 40–50% of their value in a matter of weeks, whole life cash values didn't move. Not down, not a fraction. The people who had been told this system was outdated and obsolete watched their neighbors lose decades of savings. Their own policies just kept growing. There are now an estimated 29 million whole life policies active in the United States. Most of the people holding them have never once heard the phrase infinite banking. They just inherited a policy from someone who already figured it out, which leaves one question nobody has cleanly answered. If this system is so outdated and inefficient, as the financial industry has insisted for 40 years, why do banks themselves currently hold over $170 billion of their own institutional capital inside corporate-owned whole life insurance? What do they know about this system that they've spent 40 years making sure you'd never think to ask?